Okay, traders, welcome to this live intraday strategy webinar. Today is Tuesday, August 30th, and I'm Michael Boutros. Welcome aboard. So, to get things started, we do have a lot to go over today with the dollar index. We covered yesterday in the update dollar CAD, sterling yen, dollar yen, interestingly enough, still remains in my crosshairs. We'll touch base on euro, which is on tap tomorrow. You have CPI, you have unemployment, German retail sales, a whole lot of data from Europe. And then we'll take a quick look at the Aussie as well. As always, I want to jump right into the price action, guys. So any questions, trade setups that you have, feel free to throw them on the message board. Aurelian, Dan, Eileen, Horace, Medad, Mark, Pooja, Scott, Steven. Great to see everyone in the room here today. Alan, can we take a look at the sterling crosses? Sure. Is there any specific sterling cross you want to go over, Alan? Because my focus has been on sterling yen. We covered sterling Kiwi earlier last week. We can go over that. And also, obviously, British pound, US dollar. Let me know if you want to take a look at either of those as well. Yes, yen, he says. You got it. Yeah, that's on the list. Okay, so let's jump right in. First things first, here's what the relative performance of the US dollar looks like heading into the US session. So you see that the dollar is making another run at the highs here today. Strong against most of its major counterparts. Sterling pretty much unchanged on this session. But as far as the chart is concerned for the Dow Jones FXCM dollar index, nothing has changed, guys. That same level that we discussed yesterday, 11,981, 50% retracement. This is the high close for the month as well. Continues to be sort of the range of focus for resistance on from my end. Also keep in note that that is just the simple lower median line parallel, okay, that we've been following off of the lows for the year. So either way you look at it, really nice slope here. Either way you look at it, you're still at a very contentious region for the dollar index. Remember, a much more significant resistance level lies just higher, 200-day moving average, which has offered a very clear pivot in price, and the 618 retracement off the highs. Okay, that gives you a range of basically 12,000, 1214. But the story remains unchanged. Now, as we noted in Sunday's update, we're essentially looking for a blow-off sort of exhaustion high early in the week here for the dollar index. So keep that in mind. Also keep in mind for the dollar index that we have yet to simply clear the objective monthly opening range high, which again continues to keep this sort of a range-bound trade for now. Looking at the momentum signature, same deal. Since the start of the month, you haven't really gotten much penetration below 40. We haven't really gotten any attempts at a break above 60. Really keeps this thing, the focus range, still within the monthly range here. From the 30-minute chart, here's what it looks like since the start of the week. So again, this is an hourly chart. There's the breakdown, test of resistance. Here we are again, testing that slope as resistance alongside the 50% retracement. You did see not really strong divergence, I want to say, because the close was actually right on, but faltering momentum right near the highs. So again, use some caution here. I am still looking for sort of signs of an exhaustion high. On its face, it's simply set up a weekly opening range just below resistance, and we'll use that objective break near term for some guidance. Ideal scenario, we spike higher into 12,000 before reversing, or if you break the weekly opening range low, the Friday uncovered close still is 11,953, would shift the focus lower. Okay, so I'm not really interested in playing alongside of the dollar index specifically from this point. Any questions on the greenback or broader dollar performance? Keep in mind you do have ADP on tap tomorrow morning alongside ISM, and also heading into Friday, the all-important non-farm payroll print. It's going to be tricky this time around, guys. Market liquidity is likely to be extremely thin heading into the extended holiday vacation here in the United States. So as far as non-farm payrolls on Friday, we're expecting a decent print after that 255 print that we got last month. Consensus estimates right now are somewhere around 180. And certainly that's going to be the main highlight for dollar price action heading into the end of this month, start of September trade. Also looking at things, just to put things in perspective, you know, we've been tracking the Fed Fund futures rates. Haven't really changed much since yesterday, okay? Consensus estimates are basically still calling a probability of a 61% chance for a hike in December. November and September still well below 50 as far as market consensus is concerned. And again, here's the docket for the U.S. over the next 24 hours. ADP tomorrow, heading into Thursday. Again, you're looking for those ISM numbers as well, right ahead of Friday's non-farm payroll. And again, 180 is the consensus, 255 is what we got. Also be looking for the unemployment rate, which is expected to downtick again from 4.9 to 4.8. Now, we always have the caveat here with what the labor force participation rate's doing. So if we see labor force participation tick down, it won't really be a very positive development to see this. If we see labor force participation stick at 62.8 or even uptick alongside a downtick in unemployment, that would certainly put more pressure on the Fed, i.e. dollar strength. So we'll continue to track these expectations heading into Friday, and obviously on Thursday we'll give a nice update on all the dollar crosses. Okay, let's jump into the good stuff from last night, dollar CAD. Here's what we were looking at. I still haven't taken anything on dollar CAD, and we're basically looking same thing that we're looking at with the dollar index here. I'm just looking for an exhaustion high near term. Keep in mind, we've made quite a stretch from that major key support that we came off of last week, 27.64. You had the median line there. You had basic trendline support. I think someone in these webinars actually pointed out the trendline support from back here in 2014. Irrespective, I'm not interested, again, here in the long side. I'm more interested from a scalping perspective and near-term trade perspective just to look for sort of an exhaustion high near that confluence region. You have the 618 retracement of decline, a nice sliding parallel here for the current operative slope, and the upper median line parallel for this downslope off of the recent highs. Now again, I don't want to put too much emphasis on this, but the median line did catch the lows pretty clean here. And specifically, if you bring this into a close on a line chart, you could see it doesn't get much perfect or more clear than that. So for dollar CAD, you also do have some interesting price action or some interesting event risk on tap. Tomorrow morning, we do get the release of GDP quarterly figures here for Canada. Here's what they're supposed to look like. So right into the open here of the webinar, we'll get a quick fix on it as soon as it comes out, but GDP is expected to show a nice gain here for the month of June, 0.5%. Year on year is supposed to hold at 1%. The biggest, more significant or more important print is going to be the quarterly annualized read, which is expected to show a contraction of 1.5. Now, there is a caveat on this, guys. A lot of market participants are already factoring in this weak print because of the Alberta fires that we saw in Canada during the second quarter. So keep in mind, market consensus is already expecting weakness. That's all to say. So if it comes out at negative 1.5, negative 1.4, negative 1.6, don't expect all that outright CAD weakness to necessarily really drive things. Those fires were pretty significant. We know that the impact, the economic toll was pretty severe. So keep that in mind. Okay, from a 2.4% to negative 1.5 does look pretty abrupt, but the markets are already sort of digesting that ahead of the release. So keep that in mind. We also will get right after that, a couple of days later, NFPs. So an interesting pair to look at. Here's what it looks like on the 30-minute chart. Or I guess we'll just stick with the hourly right now. So there's a couple of things. On the daily chart, you see this gray median line. A basic trend line support off the highs comes in just ahead and a little bit closer in time with that 618. So just keep this range in view for exhaustion on an upside swing here if we get it. As we noted last night, we were getting some divergence in momentum right along the highs, right, which had me looking for a short trigger while below that 100% extension. Keep in mind that the monthly open is here as well, so 130.28, 130.32. We're sitting on that as support right now. Real tight range, but another divergence point. So higher high, higher high, lower high, lower high. Sorry about that. Siri always picks up something I'm saying. But the point is, you're seeing momentum start to wane. So if we do see a last spike here, an exhaustion high, I'll be looking for short triggers into this region. If we don't get that spike and this thing just turns lower, this is an area I'd start to look for some support. 29.57. Nice pivot in price. You got that longer standing median line support. That's basically right here. and could offer a little bit of a bounce to finally get that stretch, one last stretch towards 31, 30, 66, 30, 70. Eileen says, when you get a chance, can you talk more on your pitchforks and shifts, maybe following price action for it versus fib starting points, etc., like on dollar CAD daily? Eileen, give me a little bit more background on that question. I'm not sure I get it. Pitchfork and shifts? What's shifts? Starting the pitchfork where you did. Oh, okay, so you're talking about this gray one, Eileen? So keep in mind this, guys. Our focus is always to steer and give us a gradient in the path that the market is following. And it sounds kind of abstract, but let me take this into effect. For example, the first break, this pitchfork came about as soon as we broke the ascending lower median line parallel. So for this pitchfork right here, as soon as we cleared the downside, I want to know what the trajectory is on that break. So as soon as we broke that here on the 16th, we tacked on this new pitchfork, which gave us the median line right exactly where we bottomed last week. Okay, so, or I think this was the week prior to last week, and the close Friday, 2 Fridays ago. This pitchfork, I think is what you're asking, is a modified pitchfork. So if you go into it, you can find 2 different types here. This is using the TradingView charting software, guys, which is free online. But you can choose just a regular original pitch, which we were working with for just a couple of days until we peaked out there. Then there's a shift, which takes it a little bit more towards the gradient of the inside. Then there's the modified shift, which I tend to use a lot. And all that does is basically take basic trendline support and match the slope to that slope off the low. So a modified shift, all it's going to do is take that parallel and then give you the 50 line and the upper median line parallel. Okay, and a lot of it, Eileen, is just finding the correct slope of the market. Like me and Jamie always say, guys, it's not necessarily a science, more so than an art form. So sometimes it'll take you a couple of shots, Eileen. Sometimes you'll put on a pitch, market won't respect it, you'll fly through. Okay, well maybe I should have had it modified here. Let's see if we get some reaction off the trend lines. And a lot of times it's just waiting to see if the market actually does respond to these levels. And if they do, that's where the opportunity starts to come in. I'll show you some more examples, Eileen, as we go through, but let me know if there's anything else that kind of pops out. How did you get that, right? I'd be more than happy to kind of walk you through that. Also, a really good drill to do at home, guys, is once you have the slope drawn, take a few parallels. Draw some parallels so you get the right slope and go to the most recent highs. Does that match? Yeah. Wow, that does match pretty good here. Does that match those highs? Sure does. What about down here? Wow, looks pretty cool. Right? So we once you start to see that the market has indeed responded to these slopes, then you start to put a little bit more emphasis on it and becomes a conviction trade essentially. So Eileen, you're more than welcome. Good question. Good question. Looking to see that stretch higher here right now. See if we can't get 130.67. Any questions on dollar CAD? Again, GDP tomorrow morning, quarterly read, expect that contraction of 1.5%. on Canada GDP. Next up on tap from yesterday was sterling yen. So Alan, this is for you, my man. Here's what sterling yen looks like, and then we'll jump into dollar yen. So sterling yen, the dragon, typically a pretty wide range ATR trade, has had a very clean ascending channel formation just off the lows. Here's what the daily looks like. There's really not much excitement to look at here, although I just wanted to highlight that the descending channel formation that we've been in off the highs here from, what is that, November of 2015. If you take a parallel of that off that swing low that we made in February, you could see real nice pivots here. Break, resistance, break, instant support, break, resistance, next day, break, and here we are moving higher. The major key area of resistance here is the monthly open, 135.50, just shy of, and just higher, you have 136.21, which is going to be a basic 50% retracement of the decline. Also in that region, basic trendline resistance off of the July highs. So I want to stay constructive sterling yen, although on the near-term chart, it did come into some major Fibonacci resistance, and that was tagged early in the week right here. I highlighted this setup also on Daily FX, a brief outline of it, but here's the details, guys. This is a nice confluence of the 50% retracement, excuse me, a 38.2 retracement of the decline off the highs, and a 1618 extension of the ascent off the lows. Also, remember the drill we just did, a basic trendline support, take a parallel, matched up those highs very nicely, take another parallel, look at these highs, right? So again, all it's done on its face is set up a very clean weekly opening range right below resistance. And a topside break here eyes those subsequent targets that we just noted on the daily chart at the monthly open and 136.20, 136.15. Again, near-term slope resistance and the broader 50% retracement of the decline. Okay, now this is the range in focus. If we break here, I wouldn't go chasing. I'd be looking for a pullback to get long against 34.50. If we break the bullish invalidation level, which yesterday we set to 133.14, I'd actually be looking to play the downside. Such a scenario could really see a correction much deeper towards 131.70. And more importantly, I'd be looking for this region as the major key area of support. This is the uncovered close that we made from the gap last week. And this is a basic 618 retracement of the advance. By the way, does everyone know what I mean when I say uncovered gap? That just means the market gapped higher on that Sunday open, and we never came in to fill the gap. So it was a breakaway gap. A lot of times the market will come back to fill those levels. Stephen, does that make sense? So if the market gaps higher, right? Like, for example, this is a gap, the market gap lower. We tried to fill it, it didn't fill it till the next subsequent month. And it was right here on the 14th that we actually filled that gap. He says, yes, I got it. All right, cool. Horace, thank you for that. Appreciate it. So with that said, that's the game plan here for pound yen. I like it higher, near term, above 33.14. If we do get that downside break, I'd be interested in taking short side exposure towards these initial downside targets. But again, this also is where we'd start to look for subsequent long exposure, okay, if we get that breakdown. Remember, this was a multi-week, multi-month formation that gave out. It's been a straight shot up ever since. If we start to fail here, we'd be looking for that pullback only to offer some fresh long exposure lower down. All right, heading into the U.S. session, I would actually be looking for this thing to make another attempt at that high. I'd be looking for short triggers if we do get into that region. Any questions on pound yen? Still remains constructive above 133.14. Alrighty, last up from last night, before we jump into your questions, is dollar yen. Okay, here's what the setup looks like for dollar yen. A little bit tighter of an ATR range than sterling yen, but essentially looking at a very similar play. The only thing I have with dollar yen is I'm trying to get a pullback to get long on this thing, and I think, you know, yesterday was essentially the only pullback that you were going to get. Here's the 236 retracement at 101.72. You know, I thought you're going to get a deeper pullback here to be able to get long. Didn't really get it. You started to rally pretty hard into Asia last night. Here we are making it through the London opening range highs, but I can't advocate any long exposure here, guys, because you're coming into some pretty serious resistance pretty close by. Here's a basic 38.2 retracement. This is from the decline off of the July 20th high. It's also a couple of swing high for a couple of weeks. Just higher, we added this yesterday. The measured move of the consolidation break we made last week takes you into 102.78. So 102.60, 102.78 near-term resistance for dollar yen. Again, it remains constructive, guys, so we would need a pullback to get back in. Ultimately, I am looking for a stretch into 103.53. That actually coincides on this median line and the 50% retracement a little bit later in the week, towards next week, actually. Here's what it looks like on the daily. Okay, that's this line right here. And actually, let me just copy this retracement. Boom. So you can envision a scenario where this thing spikes into resistance here and actually finds a pretty strong ceiling, pulls off into support, giving us the opportunity to get back long. The broader bullish invalidation level is now raised to 163. So remember, again, during that report last week, we were looking for a washout to the downside for a long bias. We got it on Friday, and that long bias remains in play. Last week, the bullish invalidation level was at the July low. This week, we raised the bullish invalidation level to 163. So as long as we stay above this region, I'm still going to favor buying pullbacks in dollar yen. Pretty big reactor to U.S. data, so keep that in mind as we head into Friday. We also had Stan Fisher coming out today. Keep in mind, if you guys are not keeping up with the headlines, you know, these Fed officials are going to continue. They're going to continue to come out and start throwing out all these comments as we get closer to September, as we get closer to November read. Remember, just for the record, September is the month where we get central bank rate decisions across the board, even the Swiss National Bank. So it's a big month for central bank policy. But Stan Fisher coming out today and saying, essentially, you know, don't think this is going to be a one and done. So essentially saying, if we do start raising rates, you know, expect this to be on the course or on the path for normalization, meaning, you know, it's not going to necessarily just be a 125 basis point hike and we'll sit on it for a while. Keep in mind, though, I'll play devil's advocate here. That's exactly what they said in December. And here we are waiting for December of the following year to get the next interest rate hike. So take their commentary for what you'd like. Sometimes it's good comedy. At the end of the day, we'll continue to follow price. How did you calculate that measured move for dollar yen? Did you pull it off fib? Yeah, you did. So on this move right here, Eileen, what you do is just take a basic Fibonacci retracement. I'll just do it right in front of you right now. Of the range, this is basic technical analysis 101. When you see a range break, you take the breadth of the range, as it's called, and then, whoop, you're going to put on a 200% extension. Whoops. Oh. -1, excuse me. 200 would have taken you to the downside. So it's basically measuring this range from the breakout point. And 100%, or an equal leg of the breadth of the formation, of the consolidation formation you broke, gives you a target at 102.79, 102.78. Does that make sense? Yeah, so it's the same type of measured move, Eileen, that you want to use when you're working on all kinds of different breaks, whether it's triangle break, wedge formation, even if it's a range break, if it's a flat range, measuring the breadth of the range on a 100% extension, basically measuring that range from the breakout point will typically give you a nice topside target. Okay. Any questions on dollar yen before we move off? Again, I'm flat here. I wish I was long on this opportunity last night. Did you guys see where this bottomed, by the way? I was sitting right next to Jamie. We were talking as this happened. The downside broke, and literally, you know, to go back to, what we were talking about early, literally filled the gap to the pip and moved off. So it came into Friday's close, literally right on the mark, and then reversed right higher, and here we are. So something to pay attention to. Keeps the upside bias in play. Again, near-term targets to the upside, 102.60, 102.78. All right. Hope I'm not going too fast for anyone. That is dollar yen. Next up, I do want to take a moment and go over euro. You do have CPI data, unemployment data tomorrow, German retail sales tomorrow. Here's what the euro looks like. And I do like a near-term support structure. It's also a Fibonacci confluence right at 111.39, 111.45. This is a 1618 extension from the decline off of the highs. This is a basic 50% retrace of the advance off that low. It's been a really nice clean formation that we were trading within the confines of here, guys, and we got the break to the downside. For me, on my part, I'd be looking for some support near term here. Once we get a near-term reversal or we get some divergence on a trigger break, tack on a quick retracement, and I'd be looking for that rally near term to give us a better opportunity to possibly take a short on euro. Broader picture for me, I still do like the broader euro up story, okay? But the break that we made here last week on an outside day reversal, yesterday's failure to break back above former channel resistance and the push lower back below the monthly open does keep the immediate sort of focus in my mind, at least, to the downside. All right, so inevitably, like I said, if we do get that pull lower, I would like to get long. But as it stands right now, I'd be looking for that near-term support. Maybe we can get a nice bounce off this region down here, 111.45, 111.39. I know that swing trades are also holding along on this from 112.07. So we're down a couple of pips on this one, but again, your stops are just at this region. I know Jamie has a stop at 111.45. Watch 111.39 as well. If both those regions give out, I would want to stand clear of this thing. You're likely to see a much steeper drop-off, but that is the near-term support I'd be looking for. As far as pound yen and the swing trade is concerned, again, I don't want to interfere with that. We're up a couple of hundred pips on that trade from the swing side, so while we are looking for a possible near-term pullback, trade does remain constructive, broadly speaking. So nothing really new to update here on the euro. Just look for that near-term support. Could get a little bit of a rally off that region. Bearish invalidation, what we would need to clear the bias to the downside is this, 112.70. Last week's initial opening range low, former lower median line parallel support, now resistance, 112.70 break would shift the focus back to the upside. Any questions on euro dollar? Again, here's what the economic docket looks like tomorrow for Europe. You do get the unemployment rate expected to downtick to 10.0% from 10.1. CPI also expected to uptick, but core expected to remain rather sticky. And this is the main CPI, obviously, that the ECB will be looking at, just as the Fed looks at core CPI and, more importantly, core PCE, which is the personal consumption expenditure we got yesterday. So keep your eyes on that 0.9 print expected tomorrow morning for the Eurozone. German retail sales is also on tap tomorrow. Expected to see a slight bounce back on a month-on-month basis. Really, really weak print for the year-on-year. Again, these are going to be marginal prints, guys, as far as price action for the euro, but something to keep in mind if you're in a trade heading into that event risk. Okay, so that covers euro dollar. Last but not least, from my end, I just wanted to touch base on some of the pairs that we've been following from a couple of days ago over on the intraday charts, namely Aussie Dollar, which has continued to be in my crosshairs still. Look, the weekly opening range set up just as we said yesterday, and it continues to be in focus. I like it higher, or I liked it higher above this support. Now that we're making this move lower, again, you're looking for channel support. You're looking for 75.50 if we break the weekly opening range low. Guys, if it sounds like I'm not in too many positions, it's because I'm not. Also keep in mind, like I said early in the week, it's the end of the month, thin liquidity, major event risk on tap, extended holiday vacation. So for intraday trades, it's just not our best environment to really get aggressive in. So as frustrating as it's been for me, the levels are working out. It's just the triggers have been kind of tight and the ranges start to lose momentum real quick. So we'll have to see, let the dust settle. Again, tomorrow is the close of the month, and you're likely to see those counterflow moves start to mess things up a little bit. So do use some caution if you enter fresh scalp positions today. Looking at the Aussie dollar, again, 75.90. Major resistance, it's the monthly open, 50% retracement, former trendline support from the May lows. If we break below the weekly opening range low, that'll invalidate sort of the look for the support there. You'd look for 75, 74.50, and more key support down at 74, 74.20. Any questions on Aussie? pretty clear for Aussie data for the rest of the week. Scott saying lots of sterling movement, CAD, Euro, Swiss. Yeah, but if you look at the ranges, again, if you're in those positions, Scott, for a longer duration trade, they've actually been very fruitful. Dollar CAD of all, we've been following dollar CAD for weeks, right? But from a near-term scalping standpoint, it becomes a little bit different. You want to wait a little bit for the weekly opening range to give us a little bit more of a conviction bias. Are those Eurozone points now calculating less sterling from Brexit? Are those Eurozone prints now calculating less sterling from Brexit? I would assume so. Expectations. I know what you're saying, Eileen. I would assume so. Listen, the Brexit impact is still yet to be seen, guys. The broader economic impact is still yet to be seen. Article 50 has not been triggered yet. Keep in mind that, broadly speaking, it's about the negotiation that they're going to have to open up for these trade deals with individual nations as opposed to the broader negotiation that they've signed on with the Eurozone. So until that spills over, until we see if the visa situation is going to get, cleaned up, is it going to be free flow still between the Eurozone nations? Are they going to seal that off? All of these questions are still going to have impact on retail sales, consumer spending, all this stuff. So Eileen, I do want to say that, yeah, they're probably softening their expectations due to it, but I wouldn't say that the Brexit impact has filtered into the data yet, in my humble opinion. Stephen says, how do we see the weekly opening range based on Asia? So Stephen, the weekly opening range will typically be, we're just looking for the high and low to be set early in the week. Very, very simple concept. Actually, for those of you who are interested in learning a little bit more on opening ranges, there's a great book written by Mark Fisher called The Logical Trader, in which he outlines the use of opening ranges, specifically as it pertains to the commodity pits where he used them. But the strategy or the phenomena is the same, right? Markets will tend to put in their highs and lows on the extremes. So if the market's in an uptrend, Steve, the low will tend to be early in the week and the high will tend to be late in the week. If the market is in a downtrend, the high will tend to be early in the week and the low will tend to be late in the week. So when we're looking for opening ranges, we're looking for the market to set a range really early in the week. Sometimes, Stephen, it's Monday, the Monday candle. Sometimes it's Monday, Tuesday. Okay, what you need to see is the market make a low, make a high, and then test either that low or high, or vice versa. Make a high, then make a low. But you're looking for a range to set up. So here's the weekly open, which is why on every chart, guys, I have, on my 30 minutes or my scalp charts, I have the weekly open marked. Okay, so for example, here's your opening range. It's a little bit different when you have event risk. Obviously, that throws everything out the window. But the opening range broke late in the week. We closed at the lows. Here's the start of this week. You bounced off support. You failed right around or right ahead of the monthly open, which is exactly 75.90. And then here you are testing the lows. So for me, Stephen, now your focus is on this range between 75.25 and 75.80. If it makes a topside break, you look for that extended play to the upside into resistance. If it makes a downside break of the weekly opening range, you look for the drawdown to a late week low. It doesn't necessarily need to be a Friday low, but a late week low, Thursday, Friday low. Stephen, does that help? Important thing to keep in mind when looking at opening ranges is it is not a strategy in and of itself. It is a tool. So it's like using fibs, it's like using RSI, it's like using any other technical indicator that we use, except this is an objective look at price action, right? Where RSI, people use them different ways, and even fibs, I call it a wrong use, but people use that in different ways too, draw them backwards and whatnot, right? A study on opening ranges is very objective, right? It doesn't matter what I say, it doesn't matter what Jamie says, we just broke the range for the week. So objectively, it's a good way of being able to ascertain real near-term bias. Now, Stephen, the one other thing I'd add to that is that you can use that same tool on all different time frames. So there's an opening range for each session, and that typically lasts between half an hour to an hour into the open of each session's trade. So for US, I usually look from the 8:30 to 10 o'clock span for the open of futures markets, and then 9:30 is the open of cash markets, obviously. So 8:30 to 10 o'clock will tend to give you a range. Look for that break. You can also do this on a monthly bias. So typically within the first week, Stephen, markets will tend to put in a high and test a higher low. and then the break of that will tend to look for a late month extended rally or decline. So that same type of mentality, the same type of ways that we use opening ranges on a weekly basis can be extrapolated across multiple time frames. And again, Logical Trader is a great book to kind of give you a nice introduction into that strategy. All right. Nice little discussion there. Okay, Aussie Dollar. Let's jump into your questions. I just want to touch base on the commodity block. Obviously, gold, still a quiet trade, but the levels remain unchanged. Here's the daily chart. Near-term resistance and near-term bearish invalidation, still 1330. A break below the median line. You're still looking for that drop into key support near 1287. Maybe just higher. You have that trend line support off the lows. Either way, risk remains lower below 1330. For crude's part, I do think this is still going to give everyone sort of a scare and a washout. At the end of the day, I wouldn't be surprised if it spikes back into that resistance region, the monthly highs, before it turns lower. But the risk remains to the downside on an approach into 49, essentially 48.97, which is just a basic 786. Caught the exact high last week on an outside day reversal. You have slope support, or slope resistance rather, excuse me, dating back to 2015. So there's a lot stacked up there for crude. So if we do get a break above near-term resistance, which we're testing right now, by the way, this is the high day close for the month. We're testing it right now as resistance. If you do see that break, I'd be looking for a rally into here. But again, an area to start to look for some exhaustion. All right, so there's crude and gold. We'll continue to follow these daily as we have been, just because they're making really loud headlines, right? Everyone seems to be looking at what's going on with the energy and commodity block, especially with this faltering inflation sort of globally right now. Hey, Dan, great to see you in the room, sir. It says, I saw this on Squawk, but it doesn't show as an active trade on the website. I entered the trade when the Squawk came out. Was the Squawk announcement a signal for us to enter the trade, order to short Kiwi dollar at 72.65 stop? Right. So, Dan, first of all, welcome aboard. Dan, if there's a trade that kind of pops out at us outside of the updates, absolutely, yeah, we're going to pass that your way. So just because it's outside of the reports doesn't mean it's not fair game, right? We're going to shoot that trade to you if we see it. We don't want you to miss it just because it's not, in the update. So Dan, any orders that you see come out on SB Squawk are basically orders that are being newly created outside of the report. So after he published his report, he was checking out Kiwi, and whoa, something's popping out. We'll shoot that trade right out to you. Dan, does that make sense? And if you guys aren't already, by the way, I see a lot of new names in here. If you guys aren't already, please go to the SB Trade Desk homepage and click on the SB Squawk sign-up form. You need to fill this out for me to be able to accept your Twitter request, so you can follow these on your own Twitter guides, whether you're using Squawk, TweetDeck, or any type of other Twitter reader. We just need you to fill this out so we can have a record of your account. Dan says, yes, thanks. Right on, Dan. Cheers, mate. Wesley says, hi, Mike. I'm a new member, and I was trying to attend the webinar on every Monday. How can I do this? Wesley, my man, welcome aboard. The Monday webinars are free, and those are on Daily FX. So I will tweet those links under my personal Twitter handle. You'll also see that tweet come out on SB Trade Desk, on the @SB Trade Desk handle. And that's going to be a direct link just to the GoToWebinar room. So you're not going to actually need to visit Daily FX or go to another page. I'll just tweet out the link. So that one we do public just to give the public a nice taste of what we do in here every day. And then Tuesday, Wednesday, Thursdays, obviously, Wes, we pick it up right in here. As far as Jamie's webinar is concerned, that is a weekly webinar, which we do on Wednesdays at 1 p.m. Eastern. And again, all the webinars are always archived for your consideration shortly after. Wesley says, great, awesome. Great to have you on board, Wes. Okay, who was asking about the sterling crosses earlier? Was that Alan? Alan, so we went over pound yen. Let me give you a quick look at the other pound crosses. I know you were looking at some of those. He says yes. Okay, so we covered pound yen. You're good on that, right? Here's what pound dollar looks like, and then we'll take a look at pound kiwi. It's kind of getting ugly right now, but I think with the Kiwi starting to make a move, we might get some play out of that. So pound dollar looks like this. The daily chart is pretty telling. The one reason I don't like trading pound dollar is because, guys, we're sitting right slap in the middle of the monthly range. Typically, if I'm going to take a trade, I'd like to be against some sort of structural resistance, some sort of structural support, against the monthly high, against the monthly low. You're kind of in no man's land here. So I don't really like pound dollar. If you put a gun to my head, I would say look for a move lower to buy. But don't really have enough conviction to take a position, a stern position on this. Here's the setup that we were following all last week. And if you guys remembered, as we came into this region, we started to look for short exposure. I was looking for long exposure here early in the week. I think the Sunday update, I highlighted this. Well, we broke below it. And not only that, we checked it as resistance, and we're still holding below the weekly low. So now, as long as we're below the weekly open, or excuse me, the weekly open here, which is exactly 130, 130. As long as we stay below 130, 130, I don't really want to do anything with this. You know, I want to be long, but again, we're right in the middle of the monthly range. So I'd rather look for a move lower to buy. Near 130.23 is a nice 618 retracement, nice swing low. That would be last week's low as well. Key support and broader bullish invalidations down at 129.26, and that's the low day close for the year right here. So that's my reason for not really getting too excited about the pound. Can you zoom out on the 2-hour sterling for the fork? Sure. Here we go. So here's the fork that we were working with before that breakout a couple weeks ago, right? You could see that the primary median line parallel resistance and support didn't give us too much, but guess what? These inside parallels were really clean. Resistance, 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 raised floor, okay, turning ahead of the lower parallel. There's the break of the upper parallel, tested as support, continues higher. So I still like this higher broadly above 129.26. I just don't have necessarily a play for you guys right here. The only other thing I would say on this one, Alan, is the weekly opening range is super clean, right? There's your weekly opening range high pretty much at the weekly open, and your weekly opening range low comes in at 130.55. So on its face, look for a break of that range for some near-term guidance. Eileen says, got it. Thanks. Alan says, cheers. All right, cool, Alan. And the other one I just want to touch base on with you, Alan, for the sterling crosses, man, if you're really interested in the pound, pound Kiwi, man. This thing came into a major resistance. I'll show you the setup that we've been following for the last few weeks. For those of you who have been here, this one looks very familiar. And remember, we talked about it yesterday. I said, I don't know what the hell to do with this. Usually on a break of such a parallel that's held for, almost 3 weeks here, you'd expect to see a little bit more of a rundown. So here's the first test, a break of support, checking it of resistance, and here's your weekly open now sitting as immediate support at 81.12. Daily chart looks like this, really lackluster, really lackluster. And again, same type of deal. I was looking for a rally towards the monthly open, which still takes you towards 83.30. So I like it higher. And if we do get the Kiwi to start accelerating on the loss side, I think this could see some real upside potential. Topside levels have been unchanged, okay? Inevitably, you're looking for a rally towards like 83. Oh, there's the monthly open that we just talked about, 83.30. Another one that held a good formation for a couple of weeks, over a month. All right, Alan. Hope that helps on the pound crosses. Just take a quick peek. Pound CAD, really lackluster as well. And pound Oz. I was looking at this yesterday. Oh, okay. So we're testing the this is the monthly open. On all my charts, again, for anyone who's new, on all my charts, the gray dots will always represent the weekly opens. The purple dots will always represent the monthly opens. So a nice little range trade here in pound Aus. Big resistance. Oh, I forgot about this. Big resistance. Huge. 74.30. That's the region to beat. That'll necessitate a break of the monthly open, a long-dated multi-year 618 retracement, and basic slope support parallel to resistance off last month's high right there. If we break this to the upside, your first initial play on a basic breakout, just a simple 236 retracement, takes into 176.20. So another 200 pip rally if we clear this. And that lines up perfectly. Wow, this is actually really nice. That lines up perfectly with the monthly open. I mean, the monthly opening range high. So here's your monthly open right there. Not bad. Alan says, thanks a million. Hey, Alan, my pleasure, my man. Great to see you in the room. Dan says, I took a Kiwi trade yesterday. Can you comment if you think it would still go to 69? Sure. Oh, we didn't cover Kiwi. Where's my head? All right. Okay. This is what I want to tell you. I'm not going to necessarily comment, Dan, on whether I'm personally looking for 69 because me and Jamie trade on different time frames. Again, the midweek strategy webinar is where you want to kind of pick his brain on that. We do obviously converse and always are on the same page as far as directional biases, but our trading styles are a little different, right? Our approach is identical almost, but our trading approach is a little different. He looks for the little bit wider of a trade. He's not going to be as active getting in and out of the market. He'll take a position and look for a bigger chunk. From my part, I have a weekly opening range here. Very simple. Broader bearish invalidation up here. Nothing's changed from my end. So I'm looking to sell rallies while below 72.95. And I'm looking for a move towards 71.80, 71.50. My last target is 70.99, the 71 handle. Nice swing low in price, but also a basic key 618 retracement, which we have to adjust. Excuse me, 71.15. That's actually even a better level. But that would be my last target. You know, from there you could get a rebound. We could have a little bit more structure in price, and it could get you a 100 pip rebound and move lower. From a swing side of things, Dan, that's not gonna phase you. Even if a rally's 100 pips and move back to that major, you're looking to play the bigger hand. From a near-term prospect, that 100 pip move against me on my high leverage is going to be a problem. I'd rather get out of the short, look for a re-entry on the short on a rally, or even play the rally, right? From a scalping perspective, that's what we do. So just want to keep that in mind, the difference in the duration of the trade horizons. Don't kind of just place a mat and say, okay, we're bearish Kiwi. Just, you know, if you're gonna take the position based on the swing trade, your limit is set, your stop is set. Let the market do what it's going to do. Make sense, Dan? And again, I always tell the guys, you know, there's no problem. I have it myself. You have two accounts, one of them for a longer term position type of trade strategy, one of them for a shorter term scalping strategy. In this way, if I do have a position that I'm holding for a longer duration, it allows me to take short-term positions against my longer-term bias. For those of you trading offshore, obviously FIFO is not an issue. For those of you trading here in the United States, you do need to have a separate account because it'll take you out, obviously, of the core position. Dan, hope that helps. He says, thanks again. You're more than welcome. Alan says, thanks a million. My pleasure. All right. Sterling crosses covered. Crude. What is that for Kanwal? Hey, Kanwal, great to see you. We actually did cover crude. There's not much to say on this. There's the chart for you if you want to take a screenshot. By the way, a quick reminder again, you can always click on the camera in the top right-hand corner, take a screenshot of any of the charts you see presented. Nothing's changed on my outlook for crude here, Conwall. It's still bearish sub 48.98. Near-term resistance is at the high day close. We're testing that right now. this is bearish invalidation. As long as you're below that region, you want to be mindful of the long side of crude. Okay, and guys, heading into the end of the week and the month, just be prudent. You know, if I don't even get any scalps on today into the rest of the month, it wouldn't be a surprise to me. Obviously, if there's opportunity, we're always going to seize that opportunity, but from a near-term pricing standpoint, things can get kind of hairy here. So just use some caution, okay? We'll pick things up again tomorrow, guys. We'll end it here. Keep in mind, again, that CPI data tomorrow for Bank of Canada will be coming out just as we open the webinar, so keep your eyes on dollar CAD. And we'll give you an update later tonight for the intraday. Best of luck trading. Michael, thank you. Actually, it's my first time. Thank you. Conwall, great to see you in the room, man. My pleasure. Always feel free to come up with any questions or pairs that you want to check out, okay? You're in the right place. All right, guys. Best of luck trading. See you tomorrow. Cheers.